You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi, I'm Tom Cock. I read with great interest recently a column at Market Watch. I can't always say that because I disagree with much that is written there. But Brett Arends wrote an article about why he doesn't think you should trust S&P 500 index funds. He said he doesn't care who knows it. He also said, I know the bogleheads will come for my scalp, because he knows that index funds make sense in the long haul. But he's worried today for the following reason. Points out that 5 companies make up 23% of the entire capitalization of the S&P 500. Let me point that again. 5 stocks represent almost a quarter of the capitalization of the S&P 500. So when you put your money in S&P 500 index funds, you're just putting it, a lot of it, in Apple, Microsoft, Amazon, Facebook, and Google. You may have already knew that. No, that's still better than taking a shot at Hertz, hoping they'll recover, rolling your money at Kodak, speculating there, or buying slices of stocks that now become very popular at major custodians that are trying to get your business. I always know when it's a complete fad when my non-money-oriented college professor brother calls me to ask me about that. No, slices are not a good idea. You can own slices in an index fund. We'll tell you why index funds, I think, still make sense. Brett goes on to talk about how your exposure to other parts of the market are very, very small. Just 0.2% represent in the S&P 500, he believes, represents airline stocks, less than that in department stores. And he says, if I'm going to bet on stocks, I want to spread my bets, which makes a ton of sense. And then he talks a little bit about the randomness of stock returns and about how his study looked at 50 years of data, 1964 to 2012. And if you just picked 30 random stocks, you did better than owning the index. I couldn't agree more with him there. Exactly. That's my point. Brett, you just need to widen your index a little bit. Let's talk about that for a moment. As you know, we do believe in index or index mutual funds. We give you 2 free funds at our website, talkingrealmoney.com. But it's not the S&P 500. The S&P 500 represents 500 of the largest growth-oriented companies in the United States. And now, as he points out, this huge concentration, greater, by the way, than the late 90s when growth was really going crazy, right? So what should you do instead? Well, we're going to recommend you have a global portfolio. You could own it all in one stock, in one fund, VT-WAX. Vanguard's very fine global index mutual fund. And let's look at the comparison here. A 20-year period. I think 20 years, a reasonable amount, might be a typical retirement for many people. January 2000, you bought the global portfolio and you held it through the end of July 2020. It earned 6.9% a year. Decent return. The S&P 500, which would have been the place to invest at the beginning of 2000 because the late 90s it had that huge run-up, 5.9% a year. 1% a year more by being globally diversified. And while the standard deviation is a little bit higher, the risk has to be less because you hold 8,800 securities. In the global portfolio, you only hold 500 in the S&P 500. Here's the other reason to be global today. You're buying out of favor stocks. You don't want to run your money into something that's already gone up. You want to put it in the things that is not. So right now you'd be investing in small companies, both U.S. and international. Value companies, big and small, U.S. and international. And as I just mentioned, international. Most of you are underexposed to international markets. If you just invested on sort of the value of firms around the globe, A little over 50% would be in the U.S., but the rest would be invested in other countries and other economies and other companies that have provided greater returns over time. As I mentioned, that 20-year period, 1% added per year. Brett says it would take a brave investor to bet against those 5 stocks. I'm going to differ with him completely. It takes a brave investor to say those 5 stocks will continue to rocket up for any period of time, be globally diversified, always use index mutual funds, keep your costs low, know where you're headed, and have that plan and stick with it. That would be my overall advice. And we'll be telling you more about that at a special class coming up on August 26th called Retirement and Beyond. I do this class with Rick Gregrick, who's an attorney, who's a colleague, someone we've worked with for about 25 years. It's free. You can register for it right now at TalkingRealMoney.com. Thanks for joining me. I'm Tom Cock.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?